Welcome to part 2 of module 3. We will use the 10 economic impacts described in part 1 as the structure for building the conceptual language used in the housing economic value chain that will be outlined in part 3 with Keith Lockwood. We will move from examining each impact described at the household level to understanding how all individual actions combined impact the economy at the level of the whole country. Firstly, the goods and money invested in housing by households are produced either from buying and stockpiling materials, from savings, or profits from other activities, or indeed through loans from financial institutions, family, and friends. These are all financing instruments, and in economic terms, financing instruments come from upstream in the economic value chain. They are classed as intermediate inputs because they are used in the process of producing housing, and they are classified in the tertiary or services-based part of the economy. The construction of houses creates fixed assets in the form of a house or an apartment building that will last for a long period of time. These assets accommodate households or produce rental incomes for owners. Households that build houses create operating income and profits in the housing construction sector. If they choose to live in this housing, they forego extra income they could have earned if they had not chosen to stay in the house and rent it. This is known as imputed rental. Those who build houses to rent contribute to the housing real estate sector. These owners receive regular rental income and profits from this accommodation. The value of goods and services produced in the housing construction sector, imputed rental, and housing real estate in a period all form a part of the gross value added to the economy. And the income earned minus the costs from profits, rents, and interests earnings collectively constitute the gross operating surplus generated by those sectors. The building of accommodation by households, companies, and governments constitutes the total domestic production of housing in a given year. It includes every unit, from a backyard room for a single person to a large and expensive penthouse on the top story of a luxury building. Every housing unit counts. This new domestic production of houses then adds to the total domestic supply of accommodation that is available to match the demand for houses from households themselves. Housing is either occupied by the household itself or it is rented out. In economic language, this is part of the total or gross economic value added to the economy. This available stock of accommodation, either occupied or rented, adds to the economy in that particular year. Specifically, this is part of the operating surplus component of the gross value added, that is excess income or profits that the investor in housing frees up if they live in that housing, or earns from rental income if they are renting out that housing. Profits, together with interest, rent, and wages, collectively make up income for housing. In the context of a rental business, whether a formal or informal business, the costs of providing the rental unit, those are the intermediate inputs such as cleaning services, security, and maintenance, are offset against the rents derived from it. If the rents exceed the costs, then the business or owner makes a profit. And this profit forms part of the gross operating surplus of that business. Meanwhile, the activities associated with the building and renting out of accommodation generates incomes for the owners of the different factors of production. That includes labor and capital and property and entrepreneurial skills. Collectively, this is known as the gross value added, or GVA, of those activities, because value is added to the intermediate inputs needed to build the accommodation to ensure it can be occupied or rented out. To calculate GVA, we need to measure three things. First is the contribution of the entrepreneurship, the business skills, and the capital of the owners themselves. This is the gross operating surplus. Second, inputs from and salaries paid to professionals, skilled, semi-skilled, and unskilled labor. And third, indirect taxes and subsidies. The construction and rental of accommodation also require inputs from other sectors of the economy. These are known as intermediate inputs. This process creates upstream economic stimuli for construction materials and for housing-related services such as architecture and engineering. The recently constructed fixed or immovable assets or houses forms a part of the gross fixed capital formation of the country over that period. It is added to the existing stock of housing if the number of new units constructed during a period is greater than the number of homes that were demolished or became unusable. The stock of housing at the end of that period will increase. The increase in the productive base of the economy allows the level of economic activity from housing to increase. All the impacts we have discussed so far are direct economic impacts. Let's now look at indirect economic impacts. When households occupy housing, they stimulate demand for other housing-related goods and services. These include second-round or upstream impacts created by the goods and services that form intermediate inputs into that housing. For instance, if a geyser is installed in a house, the geyser manufacturer also needs intermediate inputs. Households moving into houses will also create demand for new goods and services, such as furnishings and electronics. The process of building and renting houses often requires government inputs as well. This could be in the form of subsidies, free or cheap land, or payments for bulk infrastructure installations. Governments also provide a regulatory environment that protects ownership of housing assets through, for instance, the deeds register. Government makes money from housing construction and rental as well. Taxes are levied on goods and services, income tax is paid, and often capital gains tax is also generated through the sale of housing. And government can earn revenue from property taxes and service charges as well. The growth in the number of households owning and occupying, as well as renting accommodation, creates economic stability and growth in household income and wealth assets. Often this growth in income is used to upgrade existing houses, sell and buy larger, more valuable houses, or invest more capital in new housing rental stock. Housing is not a static process. Most households change the form and type of housing they occupy a number of times throughout their life. These actions build the housing construction sector as well as the housing rental sector of the economy, and it also expands the capital invested in the housing economy of that country as a whole. In part 2 of this module, we have described the basic economic impacts that housing has on countries' economies. We have expanded on the 10 economic impacts of housing at an individual household level. These economic concepts are applied in more detailed explanations that Keith Lockwood will take you through in part 3 of the housing economic value chain at a national economy scale. You can also refer to the glossary of terms for additional definitions and information.